Thanks for joining again. Tonight's webinar is about trading the pattern, and we're going to cover a couple of specific patterns in general, the various flavors of the wedge, pennant, flag formation, and the inverse head and shoulders. And these are three of my favorite patterns. They've become high probability patterns for me over the last couple years, and especially today in this market. So my name is Jesse at Psycho on Wall Street, and I'm with tradeonthefly.com. And we'll go ahead and get started. So what we're going to cover today, we're going to go over the wedge, the flag pennant formation, the inverse head and shoulders, what to look for in each one of those, as well as some of the questions that you guys have. Okay, let's start with the wedge. This is one of my favorite patterns. I'll give you a close-up look real quick. Just so you guys know, these patterns, they are all open to interpretation. My favorite pattern is what they call the level wedge. And just so you guys know, again, these patterns have different flavors. It's just like, you know, the differences between, you know, your daily chart and your weekly chart. There's patterns within patterns. So these are to be taken as indications. That's what they are. They're patterns. They're not set in stone. They're not rules. These are things that you can look for to help identify high probability trading setups. So a lot of the times, and I don't know if you guys know this, there's a website called investopedia.com, and it literally has every single term, definition that you could ask for as far as terminology, setups, patterns, every technical indicator out there, and even fundamentals. So before you ask a question, go ahead and go to that investopedia.com. That thing, for the first couple years of my trading, that's just where I was because I always had questions, and it's a great resource. So I'm taking these definitions from investopedia.com because that's where a lot of people go. And again, going back to some of the previous webinars, I don't want to do anything different. I want to do what everyone else is doing. So I want to watch and look for the same patterns that other technical traders are looking for. So the level wedge. In technical analysis, a security price pattern where trend lines drawn above and below, here and here, a price chart converge into an arrow shape right here. Oh, that's Ruxin in the background. He's guarding the deck. So wedge-shaped patterns are thought by technical analysts to be useful in analyzing a short to intermediate term reversal of what the analyst feels to be a major price trend. So right here, this is a trend right here. You've got your top trend line and your bottom trend line, and you can see we've got clearly defined trend lines. A couple of little wicks that dip below, but that's not something that we want to worry about. Remember, we don't want to trade 5 cents for $1. We don't want to miss $1 or $5 move on a stock because we were waiting for, you know, a to the penny 5 cent, you know, lower or what have you. So I'm looking at the pattern overall, zooming out and looking at this pattern, and I see this nice consolidating wedge forming here. And this is INAP, and I held this stock for a very, very long time and recently just exited the last of my position. But once the price breaks out of the wedge, it's expected to return to the major trend. Technical analysts see a breakout of this wedge pattern as either bullish on a breakout above the upper line or bearish on a breakout below the line. So this would be bullish on a breakout above that upper trend line and bearish on a breakdown below that upper trend line. So a level wedge is considered a period of consolidation, which will not reverse the current major trend. So what I specifically look for, and again, these are just things that I do that have helped me over the years and that I use today. So what I look for is after that move, I look for declining sell volume. And you guys see me draw this on all of my charts. I always have the average daily volume up, and I'm always checking volume on different intervals. And the reason why is because I want to see when that volume starts building. So after a move, we see our declining sell volume. We have a big spike in volume, and then we've got this slow trickle, trickle, trickle. We want to see consolidation within a defined range, and that's what this wedge is right here. This is consolidation within this wedge. And then on the break, if you're long the stock and that breaks out above the upper trend line, these are one of my rules, is I want to see at least greater than 1 times average daily volume above that trend line. And again, you can track how that volume build starts to look like by keeping a gauge on the volume of the stock on a day-to-day basis, hourly basis, etc. And that's really what I do because I trade price and volume. So that being said, you can see we've got this nice wedge forming. We've got this declining sell volume taking place after that big move. And then here we go. There's our big volume bar. And what does that volume bar do? It pushes us up, out, and through that consolidation pattern and right through a previous sticking point of 380. So again, these are patterns that are easy for me to see. They're easy for me to draw. And again, if I have to spend more than 30 seconds, drawing lines on a chart, the chart is too noisy for me. And that's, really kind of how it goes for me. And I'm not saying that's what you should do. Again, I just like to keep things simple. So what to look for? We'll do that again. Declining sell volume after the move, consolidation within that defined range, and then at least a 1 times average daily volume up through the top trend line if you're long and the bottom trend line if you're short. And here's a close-up of that chart. And again, you can see these lawns drawing on every chart. And again, I'll talk about it in a second. Volume is something that I pay attention to all of the time, because once you start watching a stock over a period of time, you get a feel for what that volume looks like on 15-minute intervals, 60-minute intervals. And you can also set volume alerts to notify you when you get that volume build coming in. So let's talk about the inverse head and shoulders. This is another one of my favorite patterns. Recently, using PEDX recently, this is one that played out nicely. They don't always, but this one kind of worked out to a T. So the inverse head and shoulders definition, again, from Investopedia. An inverse head and shoulders, often referred to, let's see if I can get that closer. There we go. Often referred to as a head and shoulders bottom, is a chart pattern used in technical analysis to predict the reversal of a current downtrend. And this pattern is identified when the price action of a security meets the following characteristics. The price falls to a trough and then rises. The price falls below the former trough and then rises again. And finally, the price falls again, but not as far as the second trough. And once the final trough is made, the price heads upward towards the resistance found near the top of the previous troughs. So when they're talking about troughs, here's that drop, here's the trough. Here's the drop, here's the trough. Come right back up to this neckline, here's the drop, and here's the trough. So you can see on this chart, we've got our first shoulder here, we've got the head forming right here, and we've got our second shoulder right here. Now what I want to look for specifically in these is a clear head and shoulders pattern. When you look up head and shoulders in your scanners and screeners, you'll see some of them that they show up, and sometimes they're pretty noisy. And so when I say I want a clear head and shoulders pattern with no chop, that means that if you look down here at VLRS, that's not bad. That's still within that trough. But when you get that chop up and down, up and down, up and down, a lot of people will trade that as an inverse H&S. I just, like every other chart I look at, I just want it to be as clear as possible, because I want other people to be able to see those lines as well. So what I look for, again, the clear pattern. It's if you can't draw those lines in 30 seconds, again, it's too noisy. And when you pull up that chart, I think it was around 565 or 575 is where I entered because of this formation. And this, you can either look at this as a cup and handle, but I look at this on the big picture as that inverse head and shoulders. So that being said, the second thing is I want to see that neckline break on volume, again, at least 1 time average daily volume, greater than 1 time average daily volume. And so, and here's, to back up a little bit, before when I was talking about how people interpret and analyze these charts differently in different flavors, you'll talk to some technical analysts that will put the neckline at 650. You'll talk to some that put the neckline at 7, and you'll talk to some that put the neckline all the way up here at 8 or at the gap. And when I entered this, I had no intentions of a measured move to be filled to completion. And a measured move is some. Michelle's a wizard at measured moves. I'm still learning them and how to interpret them. But as far as me, I just put my neckline at 650. And when I saw that break with greater than 1 times average daily volume, I added to that position for I think it was my final scale. But you can see, it's just very clear. Sometimes I feel like I should be talking about these charts more, but then I realize that that's the whole point. The charts are simple. They're easy to read, easy to understand. And not just for me, but I assume for other traders too, because I like them to be clear. So let's look at another example here. VLRS, another one, very, very clear. Shoulder, head, shoulder. And then you've got your neckline spots. Some people will put them at 1450, at 15, 1350, 14. I had this at 14. And when you see that neckline break on greater than 1 times average daily volume, that's the sign. That was my buy signal, and it worked out nicely. And again, not all of them work out like that, but it's nice when they do. Especially in this market, patterns seem to be working in a breakout market. Obviously, we're trending up, and you'll have a couple of days where we complain about breakouts not happening, but it's because we're so used to patterns playing out to fruition. So let's go to that was the inverse head and shoulders. And again, any of these guys, if you want to talk about them or review them, we'll do that in the Q&A. And that's really what I wanted to do, is kind of use that so we can look through some charts together, take some examples from you guys. We can look them up and identify the patterns within them. So let's look at the flag. Now this is my favorite pattern, and quite frankly, I think it's one that no one really knows what the actual true definition and meaning is. You've got your flag, you've got your pennant, and you've got your wedges too. Wedges can be interpreted as a flag. Essentially, to me, a flag is a big breakout that puts in a flag pole and then consolidating in a very narrow range at the top of that pole or near the top of that pole. And I believe that the actual true definition is a certain percentage above the pole. But as long as it's consolidating within 10 to 15%, even 20% of that, the highs of that move, I'm okay. So we'll look at the flag in the definition. Bullish flag formations are found in stocks with strong uptrends. They are called bull flags because the pattern resembles a flag on a pole. The pole is a result of a vertical rise in the stock right there, and there, and there. And the flag results from a period of consolidation. Here, here, and here. The flag can be a horizontal rectangle like this, but it can also often be angled down away from the prevailing trend. So that's where there's different versions of flags, and we can look at a couple of those again when we get done. But you'll have the falling flag, rising flag, or bullish flag, bearish flag, and then you've got the descending and the ascending, and then you've got your wedges, and then you've got, some people call them a box. I just look at a big move, consolidation near the highs, and then track it for volume. So what I look for, and you'll see there's similar characteristics to these setups, and it's because they're similar setups. I like to see the move. I want to see that declining sell volume after the move. So we've got our spike, we've got our decline in volume in a tight range, and then we've got that break that's greater than 1 time average daily volume right here. And that'll put in another pole and another flag. Tight consolidation, declining sell volume, and then we've got another spike to put in another pole and a really long base right here. And I've been watching AGFS for a long time, and this chart really played out nicely because it traded so tight for such a long time. And that's, Michelle talks about this too. The consolidation, the longer the consolidation, the bigger the move. So when this was consolidating and it broke out, I added to the position. And right here, you'll see that I've got a flat line rather than a declining line. And the reason why is when you get into tight consolidation periods, a lot of the times you're working on a flatter plane, a flatter horizon when it comes to that volume. So we've had consistent volume, and this breakout came, I think it was right around 1 times average daily volume, but that volume followed through. You can see tried to sell off in the morning, et cetera, et cetera. So when it comes to flags, again, you'll hear people talk about measured moves, length of the pole, and that's great. I don't want to get that technical with it yet. Again, I'm not looking for the top or bottom, just the meat in between. So if I'm holding this at 7 and it breaks out to 8, that's a great move for me. I'll take some off there. I don't care if the pole shows me a measured move to 848 or something, if that makes sense. So that being said, what I look for: declining sell volume after the move, consolidation within the flag range, and then greater than 1 times average daily volume as it breaks out through that range, that box, that flag, that pennant. And we'll see another one here with HDSN. So we've got our flagpole right here, declining volume after the move, and then a breakout on greater than 1 times average daily volume, and here's that consolidation within the range. And then there's that perk, another pole, consolidation. This is a wider range, a little bit choppy, but still pretty tight. And right there, even despite this giant sell candle right here, we have this 1 time average daily volume up, out, and through. So before I get into these questions, go ahead, and if you guys have any questions about these specific setups and the different variations, because there are several variations, and I'm sure I reference them differently than many other people. We'll go ahead and go over them now, but I think you see the very clear trend in all three of those patterns is that they're simple, they're easy to see, and when you're looking for just a single indicator to trigger with me, it's volume at a price point. It makes it a very easy mechanical robotic decision to enter and exit the trade, if that makes sense. So on the breakout plays, I want to see declining sell volume, consolidation, and then a breakout through the range on greater than 1 times average daily volume. And inverse head and shoulders, which is more of a reversal pattern. Again, it completely different pattern, but that breakout point, greater than 1 times average daily volume on a very clear area, to me, those are simple patterns and charts to find, see, and trade. If you've listened to any of the previous webinars, that's how I like to keep it as simple as possible. Let's see. Okay, so does anybody have any questions about these setups? Did that make sense? Was it easy to understand, or am I speaking a different language? Okay, stagger. Question is, on the ascending wedge, is it the further the breakout occurs from the apex of the triangle, the more significant the breakout typically? For me, again, I hope, after a move, I hope that a stock will consolidate as long as possible, because that's what I see as a higher probability, is that the longer that runway is put in, the longer that consolidation phase, that's where it's going to be the bigger the move coming out of it. So on the ascending wedge, and we'll go ahead and pull up the ascending wedge so we can get some charts in play. Let me keep that right there. Okay, so let's go ahead and this is, again, another thing. A lot of times we have these tools and we learn how to use them on the surface level, but we don't really dig into them. And I would encourage you guys, if you use tools like FinViz, etc., they've got some really cool features that can streamline your scanning process when you do start to find high probability setups for yourself. And so when we're looking at these patterns, you can see we've got signals already built in. So if you've got see the wedge up. There we go. So on these ascending triangle patterns, and let's pull up a good example. I like this one. Whoa. So VTWV, if we're going to draw that out, right there, and then, I mean, honestly, this, to me, this looks more like that, but if we're going to go an ascending wedge, what they're looking at is this right here. So that's your ascending wedge pattern. And to answer the question, I like that setup. It's slow stocks are reset, declining volume, and it's consolidating near the top of that pole, near the top of that move. So further the breakout occurs from the apex of the triangle, I mean, typically, honestly, to me, that kind of stuff is a little bit more involved than I like to get. I would just say that the longer the runway, the better. But if a stock's going to break out after a couple weeks of consolidation rather than a couple of months, I'll take that too. That's the thing. I'm in there for that 3 to 10% move over and over and over again. And so when it breaks out, I'll take some off. I'm not really concerned about how far that's going to break out, since I scale, and which I encourage new traders to do. Is that I am not a one and done. I'm not worried about maximizing my entire position. I'm maximizing that position, whether it's a 1/5 size or half size or a third size or what have you, because my entries are different. I'm just looking at percentages on those entries, and that's how I keep my trading robotic and not trying to snag the top, if that makes sense. Sorry, Stag, I tried to. Let me know if that answered your question. Okay, perfect. Anyone else? Questions on charts? If not, we'll go into the questions that were sent prior to the webinar. Okay. Oh, we got one coming in. Okay. I'll wait for it to come in. So, one of the questions was, how do you compare and plan around slow stocks in different time frames? For example, if it's oversold on the hourly chart but overbought on the daily, how does that impact how you read the chart? And that's a great question. So, let's go ahead and pull up. All right. Get that back here, and let's look at one of the recent plays, Michelle's monster Sorel. So the only way I can explain this is that if you guys are looking at a wavelength frequency, tighter the frequency, which operates within a range, the tighter the frequency and the farther you zoom out, the more it looks like a straight line. And so with charts, it's kind of the same. When you go down to the 1 minute chart, you've got high frequency action that you're looking at. But when you zoom out, things become a lot more controlled chaos, so to speak. It becomes, at least for me, it becomes easier for me to see. So that being said, within each stochastic on time frame, there's stochastic within that, if that makes sense. So you've got your daily, where you're looking at Sorel, and right here you're overbought. But if you pull down to the 15-minute chart, you could be completely oversold on the 15-minute chart. So yes, it does impact how you approach and plan the trade, but it's going to start with which time frame you select. So if you're trading on a daily time frame, then you're going to use the daily slow stochastics to manage that trade. If you're trading on an intraday and you're trading on a 15-minute time frame, that's what you built your plan off of, then you want to use the slow stochastics on a 15-minute time frame. So the only reason that I look at the internal stochastics on different time frames is, again, going back to what we were talking about earlier. It's so I can track volume. And so when I look at the volume, I look at volume at what levels. If volume comes at a very oversold level, then that's an indication for me to watch a little bit closer, because a reversal or a breakdown could be happening. And so that's price and volume are all about key levels, key areas. It's not just price and volume. You want to see volume at a certain price. So if I was watching Sorel and I wanted to buy on a break of 8, that was going to be my entry right here. If I'm monitoring the stochastics, I can see that it's pretty overbought already. So I'm either going to want to wait for a retest and confirmation, or I'm going to wait for further price discovery to find out where that base is at, if that makes sense. So as you zoom out, and that's the 15-minute level right there. So that's how I'd approach that chart on an intraday 15-minute time frame. If I'm looking at the daily, then I'm looking... See, I probably, where were we looking at in chat? 7? Okay. Now, if you're looking at this break on the daily and you're going to buy on a break of 7, I mean, your stochastics are extremely oversold. So to me, that makes more sense than if the stochastics were overbought and I'm waiting for that break. I would want to wait, again, for a retest or other indicator confirmation. The thing is on breakouts, you don't have to buy the breakout. Sometimes that's all people do, and sometimes they wait for a confirmation. Personally, I just function better when I wait for confirmation. And so when we come down here, if I wanted to buy that break of 8, we're oversold. I mean, overbought. So I'd probably want to wait, come down and retest, and see if it gets it on the next time. So these are... The stochastics are a great guide for you. They give you an idea of where it's at on a barometer, and that's what I mean when I say, hey, it's running pretty hot up here. So in this action of Sorel right here, it was the last month and a half ago, on that first monster run. Yeah, it was running a bit hot and it was pegged a bit hot. Sooner or later, a stock is going to have to take a breather. Now, here's the thing is, slow stochastics can stay pegged at 80, 90 for a lot longer than you think. And that's why I say they're just a guide. They're just to give you an idea of what's happening within those time frames. So that's a great question. Okay. And then, okay. Killa, do you trade off the completed candlestick or just when the price has been hit? That's a great question. So the question is, am I trading off of this? When I'm trading, I always trade candlesticks. I don't use line charts or mountain charts or bar charts. I just like candles. It gives me more information. It's a personal preference. So when we're talking about candlesticks and trading off of a candlestick, which is probably a whole nother webinar in general. But if you guys don't know about candlesticks, just Google candlestick or Japanese candlesticks, and Steve Nissen is, the godfather of that. There's plenty of information online so you can further understand that. But when I trade, typically I'm trading off the daily chart, unless it's an intraday play, and I go off of the close. So if it has a weak open but a strong close, unless it's going to stop me out, there's no reason for me to sell. So I trade off the completed candlestick, and when I'm talking about I want to see, 500,000 shares traded through 7. I try to attach that volume level, and that's going back to that greater than 1 times average daily volume at very specific price points. So I trade off the completed candlestick, not just when the price has been hit, and that again ties everything together. The primary or the best possible situation is being oversold at or near a moving average within a trend, and you get tons of volume, buy volume coming in. It's an extremely high probability trade, and you can see that right here with Sorel. Declining sell volume, riding that 50-day and then you get that volume build right there in that perk, and you've got what, a $1.50 move. So that's what I use as the guide when it comes to the candlesticks. And going back to the original question, the slow stochastics, that's how you can use them within different time frames. Good questions. Next question. Do you change your scans in the summer? I don't change my scans. I just understand that sometimes outside of this summer's been great action. Typically in the past, I would just expect to see less. And that's, people talk about sell in May and go away. I just like to trade. I like to trade. I enjoy it. So I trade through the summer. I don't trade my scans. If a stock is going to break out, it's going to break out. And if it's not, it's not. That's why we have stops in place. Did that make sense to everyone? Okay. Why do you only trade price and volume? Why not fundamentals or other technical indicators? Because for me, that's all I need, and that's all I want. I don't want to muddy my charts or my process up with anything other than my vitals. And that's not to say I'm not open to using other ones. I've just found something that consistently works for me, and all I want to do is make that better and higher probability. And once that's to where I want it to go, then I might look at some other fundamentals or technical indicators or what have you. But for me, if I can see the right amount of volume at the right price, it's a high probability trade for me. And those are the ones that I want to stick to. The simple, clear, high probability. And quite frankly, I have no desire to get into reading balance sheets or anything like that on a regular basis. That's just not something I desire to do. And then how do you find what group sectors are leading and why does that matter? Okay, that's a great question. And it's one of those things I was talking about with the tools that you're using. You'll see people talk about leading groups or leading sectors, like semis are leading again, or bios leading, or home builders are moving up on the leaderboard. On FinViz, it's really easy. You can click on groups and you look by sector, or you can also look by industry and narrow it down by market cap and country. But just so you can see what's going on. So one day performance today, the technology sector was the leader, primarily powered by the solar move. And really tech just had that breather and it's on a rapid comeback. So tech, utility services, basic materials, healthcare, consumer goods, financial, industrial goods, and conglomerates. And then you can look at 1 week performance to see how it's comparing. Technology still leading. Basic materials, consumer goods, 1 month performance, 3 months performance. Now, here's why this is important. In chat, we talk about sector rotation and money flow. And again, one of my primary principles is I want to buy what everybody else is buying. And it's why you'll see me sometimes attach a screenshot of institutional ownership, because I want to see institutional houses buying more than they're selling quarter over quarter. And so tracking money flow and sector rotation, typically what happens, and this is not something to go into, it just is very superficial. Typically what happens is you have a sector that gets maxed out, where valuations reach pretty ridiculous levels, etc. And you'll know because you're looking at a sector and all the charts and they're all overbought. There's just nothing to buy. And what you'll see is the money will go from one sector to another. And typically it goes from max sectors and then down to laggards. And so you'll see tech, healthcare, etc. rip, and then they'll have these huge decreases. Like IBB took a huge haircut from like 420 at the highs to 240 at the lows, and now we're back up to 320. And that was a breather. So where did money go? If they sold all of their bio stocks, where did it go? Well, a lot of it went to tech, and now tech is in that leaderboard position, and tech's hyper growth. There'll probably be money there for a while, but when that money leaves, it's going to go to another sector, and a lot of times it goes to sectors that are beaten down, which right now are oil, utilities, the financials, etc. And again, if you want to know more about that and why it's important or how you can use tracking groups, and you'll look at the industry so you can see it breaks it down by industry too. Sorry. Because the stocks that you're going to be watching are in those groups, and I want to buy groups that are pulling the basket of stocks with them. So if the leaders are running, then we're looking at the other stocks that are in that particular sector or group. So if Nvidia is running, then you're looking at, depending on what your trading process looks like, you've got companies like SIGM, MX, HIMX, other semiconductor companies that have maybe been beaten down, haven't been maxed out yet, and you can start to get a feel for where money's going and take advantage of some of those sector rotation plays. So I hope that made sense. And that's, to answer that question, you can find it typically in your trading platform. I know E-Trade does it, Thinkorswim does it, most of them do it. MarketSmith's another one that does it, and FinViz it's easy for me to read. Again, that's why I use FinViz. It's simple. So yeah, NVIDIA's a monster, big time. So that's as far as the material that I had that I wanted to share. Those three patterns are high probability patterns and setups for me. If you guys have any questions about those, you can email me anytime, or shoot me a DM in chat. And that's really what I have for tonight. So I'll leave a couple minutes if you guys have any other parting questions. If not, thanks for joining. Hopefully you can start recognizing or using some of these patterns. And feel free to bounce ideas off us anytime in the chat room if you need to set our eyes or want to make sure that you're seeing things, or that if there's anything you're not seeing. I just like this morning, I pinged Michelle on that Mayo setup and what my thoughts were, just to make sure that there was something that I wasn't seeing that she may. She kind of my filter. So can you give an example of how you scale in and out on a recent play? Yes. Let's pull up. MBRX. So this was a short, but the principles are the same. I typically wait for on the short. I wait for the exhaustion candle, but when we zoomed out on this chart, we saw where those areas were, so when I was looking at this, I had my first position. My first entry was right at 3. My second entry was at 320. Close enough. And then I had the 355, I think. So all in all, the average ended up being like 325 or 330 or something. And I had to stop at 350. But I scale at those areas. So 325 and 350. And I typically what I do is I go in fifths for my share position. So I have 5 entries, and the extra one is just an insurance entry for me. It's something that I don't use all the time, but I leave the capital available for that entry when I'm planning my trade. And so this was a short for me. My average was 325. I started at 3, 1, 2, 3. Those were my entries. And I only got 3 ads on this. And as I scaled out, when we're looking at the areas on the chart, I think the $2 level was my first target, and then I think 180 was my next, and 160 was my last, and that's because I only had 3 positions or 3 position sizes, and it hit my target, and it went lower. I think it went like 130 or something, but I got what I wanted out of the trade. So as a new trader, when I used to go all in on positions, full position size right off the bat, just for me emotionally, I didn't have the emotional maturity to handle being down a certain amount on those positions. And so I exit them early, prematurely. And 9 times out of 10, the idea was right. I just freaked myself out. So when scaling in and out allows me to dictate how freaked out I get, if that makes sense. I add a position at predetermined levels, and those scales are adequate size to my trading style. And again, everything's robotic, so by nature, I don't have any emotion in those scales, and I typically am using whole and half dollar amounts. So I hope that answered your question, Ron. Yeah, no problem. The emotional aspect of it was when you look back on things, 9 times out of 10, it's an operator error. The charts and things, once you understand it, that it's, you can see those. Understanding what it's telling you becomes another language. It's just the emotional aspect. It just takes a while to get a handle on it, because a lot of the times most people just don't exist in this situation prior to becoming a trader, so they don't have any idea how they're going to react. Good question. The dude, I'm curious why you exited your position in INAP. Because it hit my targets. It was 3%, 5%, 10%, and 20%. And once it hit my 20%, I was out, and I left my last position size on and let it ride, but I ended up getting stopped out on one of those dips. So that's why I exited. I know I could have gotten more out of it, but that wasn't my goal. My goal was just to get what the meat in the middle, not the top or bottom. Cool. Good questions. Okay. Well, I think that'll do it for tonight, everybody. Thanks again for hopping on. I hope you got something out of it. And if you need anything, just give me a shout. And hope you guys have a great rest of the evening.